Today I'm going to talk about bonds, bond yields, bond prices, bonds in portfolios or not in portfolios, etc. I'm Ben Reppond. Thank you for watching my YouTube channel. Today is September 30, 2025. I'm going to begin with Adam Taggart interviewing Jim Bianco. And this is just a little piece out of this, but Jim Bianco takes the position of that bond yields are going up, and he explains why. There are people out there who believe that, bond yields are going down, and the price of bonds is inversely correlated to the yield. So if the yields are going up, that means bond prices are coming down and vice versa. So this is very important. It's also important because traditional financial advisors put bonds, different kinds of bonds, in investment portfolios as a non-correlated asset, hopefully to stocks. So what happens with bonds from this point forward is significant. Using the long-term government bond, prices of the bonds have gone down about 50% over the last 5 to 6 years. 50% drop. And if bonds are used as an insurance policy, a safety asset against equity risk, and the bond prices are going down 50% over the last 5 years, it's not a straight line, but it's definitely moving in a downward direction. That, in my opinion, puts into play the question of how do you design portfolios? How do you design equity risk out of portfolios? It's a big question. This is not, for probably 70 years or so. Investment advisors, business schools have all believed and taught that you put bonds together with equities to create some kind of a balance. I have maintained the position for a long time that is, to me personally, it makes a very bad investment portfolio. When equities are going up, bonds put a drag on the return, quite a drag on return. When we are in a period where bonds just consistently are going down because yields are going up, then it's, no matter which way equities are going, it's pushing prices, either muting the rate of return or it's exacerbating the loss. So anyway, I saw this and I thought it was and Jim Bianco is extremely credible, and I think he makes a good point of what's going on with yields and with bond prices. So I'm going to play this, and then I want to make a comment. I want to show you a chart, a long-term chart over a long period of time, and show you what's going on with prices and yields. So take a listen to Jim Bianco.
So I think really what the market is saying is, if you're going to continue, let me put this number for everybody to understand. The budget deficit, the budget of the United States federal government is $7 trillion a year. We raise about 5 of that in taxes. So the other 2 we borrow. What we're looking at here is maybe that 2 becomes 2.5 over the next couple of years. That's a lot of demand on the capital markets that the federal government is looking at doing. It wants to suck $2 to $2.5 trillion a year out of capital markets into bonds. There's an old saying in the bond market, I've often used it. There are no bad bonds. There's only bad prices. Can the bond market get that $2.5 trillion? Yes, it will get it. How will it get it? It will take interest rates up so high that it'll make it such an attractive deal to put your money in government bonds, you'll willingly take it out of the stock market or anywhere else you have it to put it in the government bonds. Oh, I'm not going to do that at 5 or 6% yield. Don't say that, because we'll just keep going till we find that level where you're going to wind up putting your money into the bond market. Now, that's not going to happen immediately over time. I mean, immediately in the short period, but over time, this huge deficit is going to continue to push on yields going up and up. And why I started with the inflation argument is we're not at that extreme level now. We're at pretty normal levels. So I think that those rates are going to keep going higher from here.
Okay, next I want to show you a chart. This is just, it's a great chart. You don't see this very often. And it's a chart, an overlay of bond yields and bond prices. So it shows the inverse correlation, so you can see when one goes down, the other one goes up, and vice versa. This goes back to I'm sorry, I don't see F for it. Hold on. This goes back to 1926, I think, 26 or 28. So this is about 100 years. And you can see the light blue line when is the yield, and the dark blue line is the price. So in the yield, the amount that they pay as a, quote, dividend, you can see it goes up all the way to the late 70s, early 80s, when, interest rates and yields were very high. And then it has been in a steady decline since that, going from yields up in the teens, bond yields maybe 15, interest rates maybe 18, all the way down to bond yields going down to about 2%, and interest rates going down to almost zero. So these are long periods of time. These are 30, 40-year cycles. And so what the business schools don't teach, and the financial advisors either don't know or know and don't tell you, is that we are now we entered probably 5 years ago, a new cycle, because interest rates came down and hit effectively zero. Bond yields came down to about 2%. Where are they going to go from there? There's only one way to go, and that's up. So, which means that bond prices have nowhere to go but down for probably 30 to 40 years if you believe in long-term macro cycles. And that's what this is. So I think, and Jim Bianco makes the case for the fact that, we're headed into a period of higher interest rates. Most people believe that anyway, but there are a few people who take the other position. What that means is that when financial advisors put together, traditional financial advisors put together stock and bond portfolios, stock 60, bonds 40, or 50-50, whatever they do, it means that that portfolio over time, if this is true, and I believe it is, that the portfolio is going to have a very anemic rate of return, and years for certain, a number of years where the return is going to be negative, because the bonds are going to put such a drag on the rate on the return for the entire portfolio. So that's one point. The other point I want to make is that institutions, and I'm going to use colleges, endowment funds. Endowment funds go anywhere from Harvard being above 50 billion all the way down to smaller ones that are a billion or less. But I'm going to focus on those that are primarily, let's say, 10 to 50 billion. Those are the big name schools, many of them Ivy League schools and so forth. And I know I had the privilege of meeting the investment manager at Notre Dame, and got to speak with him, and then I did a lot of research on them and others like Yale and Harvard and Princeton and Stanford and so forth. And what I learned was that they do not believe in bonds, mostly. I won't say they don't buy a bond somewhere, Some of you are familiar with tips, but other than maybe a small amount in tips, not really. They're just not a believer in bonds. And Notre Dame, who has been way ahead of virtually every university as far as for 30 years, as far as rate of return and risk, that has not. They don't. I know they don't buy bonds, and so, and my research tells me that the others buy extremely small amount or none at all. So why is that? Because they want a consistent rate of return. They've got scholarships and, you know, to provide to the students, and like in a number of cases, and I think Notre Dame's one of them, where they actually subsidize the operating costs of the university as much as 30% or more of the operating budget of the university is paid for by the endowment fund. So, and teachers or professors' pensions and things like that. So they want stability. They want everything that other investors want, a good rate of return and consistency. If they want that, why wouldn't they buy bonds? Because the financial advisors are telling you that you have to have bonds in order to achieve that. Your average run-of-the-mill vanilla investment advisor is going to tell you you need stocks and bonds, and they just are taught that. And that's what the mantra that you say. But if you need it, why don't these institutions dealing in billions need it? And then if you look at the major people in the investment industry, I wrote down some names that based on what they've said, based on what I've heard them record, and most of what they do is private, so it's not too available. But based on what they say, I would say they don't believe in bonds, or if they have any, it's a very small amount. People like, for example, Warren Buffett. He has been emphatic in his position of he doesn't believe in bonds and doesn't own bonds. Seth Klarman, John Paulson, Paul Tudor Jones, Stanley Druckenmiller, Jim Rogers, Felix Zulauf, Bill Ackman, Ken Griffin, etc. Those type people who deal in the billions or tens of billions or whatever, I guess in Buffett's case, hundreds of billions, they don't buy bonds. So why are you told to buy bonds, that you need it somehow and they don't? There's other ways to manage your risk. I have my way, there are other ways to do it. But because they believe, they're taught this, because they came into the business during the last 40 years, 45 years. So for example, if you look at this chart, you see that the light blue line on the right side of the light blue line is going down. That's interest rates going from 15% or 18 down to 0, or 15 down to 2 in the case of bond yields. And so most people who are telling you this came into the investment business in the last 40, 45 years. Think about it. So they came in a period when bond prices were generally going up and up and up. So they believed, I don't think they say it this way, but I think they believed this was going to go to the moon, that bond prices just go up and are nicely non-correlated and help enhance portfolios. What I don't think they were taught was that bond prices go the other way. Bond prices can come down, and they come down when yields start to go up. And this chart shows both. So my point is, if you're in it, I know some of you are in 60-40 stock and bond portfolios, this just explains why you are where you are. And if you're scratching your head thinking, this thing is going nowhere, it's either negative returns or anemic returns, this is why. Thank you for watching. If you have questions or comments, leave them in the comments section below.